Welcome to the deep dive. We gather a whole pile of different sources, investment guides, research papers, behavioral studies, and try to pull out the really core ideas you need to succeed. Today, we're diving into real estate, but we're going way beyond just, buying a house. We've got material looking at property as this mix of smart financing, tax strategies, and just plain good personal execution.
Absolutely. That's the mission today, right? To connect these dots, show how things like disciplined habits link up with, well, pretty aggressive financial moves. It's about giving you a clearer picture, sorting the high-value stuff from the low-value time wasters.
Okay, sounds like a plan.
Yeah.
A big one. So let's get started. Where do we begin those strategic foundations, how to actually get and structure this real estate wealth?
Well, the first thing that jumps out from all these sources is this. Real wealth in property isn't really about waiting for the market to go up. It's about being aggressive right at the start, when you buy.
Right. Maximizing your return from day one. And that starts with the price, doesn't it? Buying below market value. The math they show is, well, it's pretty compelling.
It's incredibly powerful. Buying at a discount fundamentally changes your return rate, gives you instant equity.
Okay, break that down, the leverage effect.
Sure. So say a place is worth $120,000. You put down $24,000, that's your 20%. If the market goes up just 5% in year one, that's $6,000 profit. On your $24K cash, that's a 25% return. Not bad.
Okay, standard appreciation.
But if you manage to buy that same property for, say, $110,000 instead of $120,000, you just gained an extra $10,000 in equity immediately on day one.
Ah, so your return jumps way up before the market even does anything.
Exactly. That initial advantage is huge, which means you need to be good at negotiation. And the sources get pretty specific almost. A high pressure about the tactics.
High pressure how? What are we talking about?
It's about forcing a decision, not just chatting. First key question, are you ready to sell today?
Today. Wow, that is direct. Why today?
Because it cuts through the maybe. It makes the seller face their own timeline, their own motivation. If they say yes, boom, make an offer. But the real moment, the critical part, is if they say no to your first offer.
Okay, they reject the low ball.
Oh, what then? Immediately you ask the second question. Okay, what price will you accept?
And then, this is where the tactic comes in.
Yes. Ask the question and then shut up. Complete silence.
Silence. Really?
Total silence. Don't say a word. It puts the pressure on them to fill that silence, to actually name their number, their counteroffer. If you talk, you let them off the hook. If you let them walk away to think about it.
Someone else might jump in.
Exactly. Someone offers $5,000 more than you did, and poof, the deal's gone. You lost the momentum. You have to capture it right then and there.
That makes sense.
Oh,
okay, so this idea of forcing appreciation, getting value up front, it leads right into what the sources call the gold standard for building wealth this way, the BRRR method.
Ah, yes. BRRRR. Buy, rehab, rent, refinance, repeat. It's highlighted everywhere as probably the most efficient way to do this. Why? Because it's built around forcing that appreciation and getting your initial capital back out of the deal. It uses debt smartly.
Okay, I think we need to walk through this one, especially the refinance and repeat parts. That's where the magic happens, right? How does that 70.7% ROI example actually work?
Right. Let's use their example. You buy a fixer-upper, maybe for $80,000. You spend $20,000 on the rehab. So you're all in for $100,000.
Okay.
But because you did a good rehab, maybe added square footage, a bathroom, the property now appraises for, say, $130,000. That's the forced appreciation.
So value's $130K, investment was $100. You've created $30,000 in equity.
Exactly. Now the refinance step. A lender might give you 75% of that new appraised value. 75% of $130,000 is $97,500.
$97,500.
Yeah.
Wait, you invested $100,000 and you pull out $97,500 in the refinance.
Pretty much. In that example, maybe you only leave $6,500 of your own cash in the deal after the refi. You've recovered almost all your initial capital, plus you have the equity gain if you factor in the rental income too.
That's where the huge ROI comes from. That 70.7% isn't on the whole property value. It's on the tiny bit of cash you left in the deal.
Precisely. It's leveraged return on the cash remaining. That's why the type of rehab is so critical. Adding real value square footage, beds, baths, that's what justifies the higher appraisal needed for the cash-out refinance. It's not just cosmetic fixes. Hashtag tags, hashtag BMLO, financing, and debt management.
Okay, so acquisition is nailed down, then comes financing. And the sources seem keen on looking beyond just, your local bank.
Definitely. Banks can be slow, expensive, lots of overhead baked into their rates. The idea is to cut out that middleman. Go direct.
How? Borrowing from other investors.
Yeah, people with money sitting in self-directed retirement accounts, maybe short-term funds, they want a better return than the 1% the bank gives them on deposits. You offer them, say, 6%.
Ah, so they get a better rate, and you potentially get a better rate or more flexible terms than the bank because you skip the bank's overhead and profit margin. Win-win.
Exactly. It's about finding those private capital sources. Now, accessing equity you already have in rentals, that's a bit different these days.
Okay, how so?
Helo seeks home equity lines of credit on rental properties. Much harder to find now than maybe 10, 15 years ago. The sources warn about that. Banks just got more cautious about non-owner occupied places after the last downturn.
So if a standard HELOC is out, what are the options to tap that equity without selling the property?
You often have to look at more specialized lenders. Maybe portfolio lenders, banks that keep loans on their own books instead of selling them off. Or even hard money lenders. They might offer second mortgages on rentals.
But likely at higher rates, I imagine.
Usually, yes. The terms will reflect that higher perceived risk. Now, moving up to commercial lending for bigger deals or multiple properties, establishing a relationship is key. The sources say you need to make it easy for the lender to say yes.
Easy. How do you make a $1 million loan decision easy? Beyond just having good numbers, I mean.
It's about positioning. You want to structure it like a mutually beneficial partnership. One really interesting tactic mentioned is actively referring other good business to your commercial lender.
Wait, sending them new clients? Seriously? Doesn't that seem odd? Or maybe a conflict?
Not if you handle it right. Think about it from the lender's perspective. Their job is to deploy capital to make loans. If you become a reliable source, bringing them other qualified borrowers for good deals.
You become more valuable to them than just your own loan application. You're a business generator.
Exactly. You're helping them make money. It builds trust. It builds sort of a strategic alignment, that relationship capital. It can absolutely translate into better terms, maybe lower rates, more flexibility on your deals down the line. You're not just another borrower. You're a partner in their success.
Huh. That's a really sophisticated way to think about that relationship.
Yeah.
I like that. Hashtag high taxi, tenant management, and risk mitigation.
Okay, so you've got the property, got the financing. Now you have to protect that investment. And that means solid operational management, especially with tenants. Bad tenant management can wipe out all the gains you made on the purchase.
Right. So fundamentals first. Collecting that initial payment, first month's rent, security deposit. What's the rule there?
Cash or money order only, period.
Why so strict? No cashier's checks even.
The sources are adamant. Old or out-of-town cashier's checks. Believe it or not, they can sometimes be stopped. It's a risk. Cash or a money order is verifiable. Funds are available immediately. No bouncing checks, no delays.
And the security deposit. Sometimes people want to pay that in installments.
Never, absolutely never accept a partial security deposit and give them the keys.
Why not?
Because in many places, you can only evict for non-payment of rent, not the deposit. If you let them in with only half the deposit, you've lost your leverage to collect the rest. Prorate the first month's rent if needed based on move-in date, sure, but get the full security deposit up front. Sets the tone. Contracts matter.
Makes sense. Okay, what about vacancy? That's a big profit killer between tenants. Any simple tricks?
Yes, a really smart, simple one, strategic lease timing. Don't just do a standard 12-month lease automatically.
Okay, what then?
Consider starting with a 15 or 16-month lease for the first term.
Why? What does that achieve?
It helps ensure the lease expires in the spring or early summer. That's peak rental season.
Ah, so you're not trying to find a new tenant in like November or December when nobody wants to move.
Exactly. A lease ending in the dead of winter means longer vacancy, maybe needing to drop the rent to attract someone. Timing it for peak season can literally save you thousands in lost income over the years. It's simple, but effective.
That's clever. Okay, last point here. Problem tenants. Or just, enforcing the lease terms. What's the key?
Consistency. Absolute boring consistency, especially with late rent.
Meaning?
If rent is due on the 1st and late after the 5th, then on the 6th, the late fee notice goes out every single time. No exceptions, no, I'll let it slide this once.
Why is that so critical? Seems a bit harsh sometimes.
Because if you don't enforce it consistently, the tenant learns the rules don't really matter. The incentive to pay on time disappears. Consistent enforcement maintains the boundaries, protects your cash flow, and honestly reduces future problems.
All right, we've covered the ground game buying, managing. Now let's zoom out a bit, look at the bigger financial picture. And that has to start with taxes, right? The sources seem to emphasize this hugely. Hashtag, hashtag, hack A. leveraging the tax system.
Oh, absolutely. You cannot separate successful real estate investing from smart, proactive tax planning.
Right.
Your CPA isn't just someone who fills out forms in April. They need to be, as one source put it, your forest watcher.
Forest watcher. I like that. Explain.
Your bookkeeper tracks the individual trees, the transactions. Your CPA needs to see the whole forest, the big picture, potential dangers, long-term opportunities. They need to be looking ahead.
So it's an investment, not just an expense, paying for that high-level view.
Exactly, and it pays for itself many times over. But the key is proactive. Tax planning happens before you buy, before you sell, not afterwards trying to clean up a mess.
Okay, let's get specific. One huge tax advantage mentioned is how losses are treated. This sounds important.
It's huge and unique to real estate compared to, say, stocks. Here's the deal. If you sell a rental property at a loss,
Which can happen,
Yeah.
right? Especially after depreciation.
right, if you sell at a loss, that loss is generally treated as an ordinary loss, not a capital loss.
Okay, ordinary versus capital loss. Why does that matter so much for someone maybe more used to stock market investing?
It matters enormously because of IRS limits. Capital losses like selling stock for less than you paid can offset capital gains, sure. But if you have more losses than gains, you can only use $3,000 of that excess capital loss to offset your regular income, like your salary, each year. The rest gets carried forward.
So a $50,000 stock loss might only save you taxes on $3,000 of income this year.
Correct. But if you have a $50,000 ordinary loss from selling that rental property, there's no $3,000 annual limit against your ordinary income. In many cases, you could potentially use that entire $50,000 loss to reduce your taxable income from your job or business this year.
Wow. Okay, that is a massive difference. That's incredibly powerful for offsetting high income.
It really is. It's one of the big, often overlooked tax advantages of holding investment property. Makes having that CPA planning essential.
Definitely. Okay, what about the other big one? The 1031 exchange. This is for deferring taxes on gains, right?
Correct. A 1031 is a great tool if you're selling a property that's gone up a lot in value, facing a big tax bill, and you want to roll those profits directly into buying another similar investment property. It lets you kick the tax can down the road.
But it sounds complicated. What are the absolute must-know rules? The deadlines.
Two crucial, non-negotiable deadlines. First, you have just 45 days from the date you close the sale of your old property to formally identify, in writing, the potential replacement properties you might buy.
45 days. That's incredibly tight.
It is.
Yeah.
Miss that deadline, the whole exchange fails and the tax is due. Second, you have a total of 180 days from the closing date of the old property to actually close on the purchase of one or more of those identified like-kind replacement properties.
So 180 days total, but the options have to be locked down within the first 45. That requires serious planning.
It absolutely does, which brings up an important point from the sources. A 1031 isn't always the answer.
When wouldn't you use it? If you can defer taxes, why not?
Well, if your expected tax bill from a sale is actually pretty small anyway, maybe you have other losses carrying forward that will offset the gain. Or your gain itself isn't huge after depreciation recapture, then the cost and complexity of doing a 1031, hiring the required intermediary. It might just not be worth the hassle compared to the tax you'd actually save. You have to weigh the benefit against the burden. Hashtag B, investment philosophy and market efficiency.
Okay, stepping back again. We've talked a lot about active real estate investing, but how does this stack up against just, putting money in the stock market? Does everyone need to be a landlord?
No, absolutely not. The sources are pretty clear on this. For many, maybe even most, individual investors, getting real estate exposure through things like REITs, real estate investment trusts, is probably a much smarter, simpler path than direct ownership.
REITs, those are like mutual funds for property, right? They own big portfolios.
Exactly. You buy shares, you own a tiny piece of potentially hundreds of properties, shopping malls, office buildings, apartments, data centers. It gives you diversification instantly, which you don't get with one rental house.
And income, right. Don't they pay dividends?
Yes, usually significant dividends. By law, they have to distribute most of their taxable income to shareholders. So you get that income stream, that cash flow, while still having exposure to the underlying real estate assets. It pays you to wait.
So REITs for passive exposure. What about active versus passive in general, like stock picking versus just buying an index fund?
Well, the data there is pretty brutal for active management. Consistently, year after year, something like 80%, sometimes more, of actively managed funds fail to beat their benchmark index, like the S&P 500.
80% fail. Why?
Mostly costs, frictional costs. Active funds have managers to pay, higher trading costs, research expenses. Index funds just track the market automatically, so their fees are incredibly low. That cost difference compounds over time and makes it really, really hard for active managers to win long term.
So the argument is, for most people, simple, low-cost indexing is likely the better bet for long-term wealth building in the stock market.
The evidence strongly suggests that yes, it's reliable, it's diversified, it's cheap.
And this ties into another warning from behavioral finance. The danger of crowds. Groupthink applies to stocks and real estate.
Oh, absolutely. Markets aren't always rational calculators. They're driven by human psychology, fear, greed, herd mentality. History is littered with examples, right? Dutch tulip bulbs in the 1600s, the dot-com bubble around 2000.
People just pile in because everyone else is piling and pushing prices way beyond any reasonable value.
Exactly. Pathological crowd behavior. The group reinforces its own potentially wrong decisions. And you can see the same dynamics in a hot local housing market sometimes. FOMO, fear of missing out, drives prices up rapidly. The smart investor needs to recognize when the crowd might be getting irrational and maybe step back. Which brings us to maybe the most important part. It's often not about knowing what to do, it's about actually doing it. Execution. So we need to shift focus from the technical stuff to the human element, habits, influence, psychology. Hashtag AFE, the role of personal execution and habits.
Right, because the best strategy in the world is useless if you don't implement it. The sources talk about habits being key, defining a habit as what? Something automatic.
Yeah, basically a behavior repeated enough times that it becomes automatic. It's your brain's way of saving effort. And every single habit, good or bad, runs on this four-step loop.
Okay, the 4 steps, let's hear them.
First, the cue, the trigger that kicks things off. Second, the craving, the motivation, the desire linked to the cue. Third, the response, the actual habit, the action you take. And fourth, the reward, the payoff that makes your brain say, nice, let's do that again.
Cue, craving, response, reward. Okay, so to build good habits, like maybe consistently analyzing deals or making calls, you need to hack that loop.
Exactly, using what the sources call the 4 laws of behavior change. To manage the cue, you make it obvious. To manage the craving, you make it attractive. To manage the response, you make it easy. And for the reward, you make it satisfying.
Okay, give me an example. Let's say I want to get better at networking.
Okay, make it obvious. Put a recurring reminder in your calendar every day to reach out to one contact. Make it attractive. Pair it with something you enjoy, like doing it while having your morning coffee. Make it easy. Start small. Just send 1 email or text. Don't aim for an hour of calls right away. Make it satisfying. Track your progress. Maybe put a check mark on a calendar each day you do it. That little visual win feels good.
So it's about designing your environment and process to support the habit, lowering the friction.
Precisely. And sometimes changing your environment is the easiest way to change a habit. Starting fresh in a new space removes old cues that trigger bad habits.
This sounds like it requires real intention with your time, not just reacting.
Absolutely. Which leads to the idea of performance time, something core to systems like the 12-week year.
Performance time, like blocking out specific time slots.
Yes, but more than that, it's about acting like the CEO of your own life or business. You decide proactively what the most important things are based on your goals, and you block out dedicated time to work only on those high-value activities, protecting that time fiercely from distractions.
So it's not just about being busy, it's about being busy on the right things. Choosing the high-value stuff over the low-value urgent stuff that always pops up.
That's the essence of it. The 12-week year idea emphasizes you're always making a choice not between good and bad tasks, but between higher and lower value uses of your limited time. Intentional planning forces you to prioritize what truly moves the needle. Hashtag B, social dynamics and influence. Execution isn't just about your own habits, though. It's about dealing with other people, sellers, buyers, agents, lenders. So you need to understand influence. And a big one is the reciprocity rule.
Reciprocity. The idea that if someone does something for you, you feel obligated to do something back. Right. It's like fundamental to society.
It is fundamental. It helps society function. But it can be exploited because the rule creates a feeling of obligation, sometimes even for uninvited favors. Someone gives you a small, unsolicited gift, and you suddenly feel indebted. Then they ask for a much larger favor in return.
So they trigger the obligation with something small, then cash it in for something big, an unequal exchange.
Exactly. The person initiating controls both ends of the exchange. It's a subtle but powerful persuasion technique used in sales and negotiation all the time. You need to be aware of it.
Okay, what else? Information asymmetry. That sounds like jargon.
It just means one party knows more than the other. Think about a real estate agent and their client. The agent has access to way more data, market insights, deal flow.
Than the average buyer or seller.
Right. And that knowledge gap creates an asymmetry. Sometimes an agent's incentive, maybe to close a deal quickly, might not perfectly align with the client's best interest, which might be to wait for a better offer or hold out for a specific property. The agent might leverage their information advantage, consciously or not.
So as the client, you need to be aware that incentives might not perfectly match up.
Exactly. Which leads to a key negotiation point. Always try to look past the stated positions, what someone says they want, like, I need this price, and try to understand your underlying motivations.
The why behind the what's.
Precisely. What are they really worried about? What do they hope to achieve? Is the seller demanding a high price because they need the cash for retirement, or because they just think the market supports it? Understanding the motivation gives you way more room to find creative solutions than just haggling over the position.
That makes sense. Find the underlying need. Okay, one more thing from the sources on communication. The story brand idea. Be the guide, not the hero.
Yes. This is crucial for anyone in a professional or sales role. Your customer is the hero of their own story, facing a problem. You are the guide, the Yoda to their Luke Skywalker.
So don't talk about how great you are.
No. Talk about how you understand their problem and how you can help them solve it. Position yourself as the experienced guide who can lead them to success. Simple, clear messages focused on the customer's problem and your plan to fix it. That's what works. Complexity and self-focus. They kill sales.
All right, last section. Let's look forward. Real estate has traditionally been kind of slow, paper-heavy, right? Lagging behind other industries in tech adoption. But that seems to be changing fast. Hashtag, tag, a prop tech and market transformation.
Oh, dramatically. Property technology is this huge wave that's hitting every single part of the industry. Buying, selling, leasing, financing, managing. It's all being digitized and optimized.
So what kinds of tools are we seeing?
All sorts. Sophisticated CRM systems, way beyond just contact lists. They track client behavior, preferences, allow for really targeted marketing.
Okay.
Virtual reality and augmented reality for property tours. Huge for remote buyers or just saving time. People can walk through a place in 3D from their couch. Appraisers are using advanced algorithms, predictive analytics now, not just old comp spreadsheets.
And data. That's always been a problem, right? Fragmented information.
Exactly. That's a big area for prop tech. Centralized data platforms are emerging, pulling together information from MLS, public records, even off-market data. Tools like Casafari were mentioned. They clean up that chaos, making it much easier for professionals to find deals, analyze values, track ownership.
So more transparency, more accessible data.
Yeah.
What does that mean for, say, traditional real estate brokers?
It's definitely changing their role. Their value used to be heavily based on having exclusive access to information and relationships. Now that data is becoming more democratized.
Their value has to shift.
It has to shift more towards interpretation, analysis, negotiation skill, high-touch service, things the data alone can't provide. They need to be advisors and strategists, not just gatekeepers of information. Hashtag, tag, be blockchain as a tool for security and efficiency.
And looking even further ahead, maybe the biggest potential disruption is blockchain, using it for the actual transaction process.
Yes, that's seen as having huge potential, especially for tackling transaction friction and fraud.
What's the main benefit?
The core idea is creating transparent and, crucially, tamper-proof records. Real estate deals involve so many parties, so many documents, title, lending, inspections. It's complex and historically vulnerable.
So blockchain creates a secure, shared ledger.
Exactly. A distributed ledger that everyone involved can see and trust. It could reference the property details, the ownership history, the transaction steps, all recorded permanently and securely. This isn't really about using Bitcoin to buy a house. It's about the underlying ledger technology.
What could that improve specifically?
Things like title verification could become much faster and cheaper, maybe even reducing the need for traditional title insurance over time. Due diligence could be streamlined. The actual transfer of ownership could become more efficient.
And things like smart contracts, automated payments.
That's where it gets really interesting. Smart contracts code that automatically executes when certain conditions are met, like releasing funds when title is confirmed clear, could automate huge chunks of the closing process. It promises faster, cheaper, and significantly more secure transactions down the road.
So a much more efficient, less fragmented future for how deals actually get done.
That's the vision, definitely. Moving away from the slow, paper-based system with lots of potential failure points.
Wow. Okay, we have covered a ton of ground.
Mm.
Strategy, finance, psychology, technology. How do we tie all these threads together? What's the big takeaway?
I think the synthesis is this. Building wealth, especially in real estate, isn't about just one thing. It demands strategic buying, getting that discount, using methods like BRRRR to recycle capital. It absolutely requires understanding the financial structure, taxes, leverage, finding the right kind of debt.
But the best financial model falls apart without execution.
Exactly. So it needs that rigorous personal accountability. Using your time intentionally, like with performance time, mastering your own habits, understanding how to influence and negotiate effectively by focusing on motivations.
And now, layering on top of all that, the need to understand and leverage new technologies like prop tech and potentially blockchain.
Right. So maybe the final thought to leave people with is this. We know traditional markets, like stocks, have volatility, they have herd behavior. We also know real estate, done right, offers potential for forced appreciation and long-term compounding, but it demands active involvement in navigating things like information gaps. So the question for you, the listener, is how do you balance that? Where does your own temperament fit? Are you more suited to passive indexing or the active, hands-on, sometimes messy world of direct property investment with all its challenges and potential rewards?
That's a great question to ponder. It comes down to knowing yourself and your goals. Our challenge to you: apply that principle of intentionality. Think about your next financial step, big or small, and approach it with purpose. Thanks for joining us on The Deep Dive.